If you look at the number of people that's on our platform today, we're seeing 23% up versus last year. That's the number of transactions. If you look at the number of rides people are taking, it's up 7% now on a year-over-year basis per user. So people are spending more on our platform today, and also people are more interacting on our platform today. And why is that? If you look at the level of services that we do today, it's essentially a core everyday needs. People still need to go to work. People still need to go to point A to point B. People still need to eat, and people still want to have access to buy all our non-food services also by on demand. And how do you make it affordable, which is really important. Despite some of these macroeconomic that you're seeing around the world, we have to make our products more affordable, accessible, and reliable. And that's what we've been focusing on for the past few quarters. And we're seeing this playing out now in the results that you're seeing today.
Peter, JP Ong here. It's an interesting picture you're painting because when I speak to various people across Southeast Asia, we do get hints that consumer confidence is indeed being challenged because of the rising costs and also the economic uncertainty. But again, when you look at the numbers here in Grab, especially based on these Q2 results, it seems that customer confidence or consumer confidence on Grab doesn't seem to have taken a hit. In fact, you're seeing more sustained growth actually based on these Q2 results. What do you think is different? And is there a difference with regards to consumer confidence when you compare digital consumer confidence, I can call it that for Grab, versus a broader consumer confidence as we traditionally know it?
Yeah, it really becomes all down to making our products more accessible and affordable, especially in Southeast Asia, where it is a very highly competitive, dynamic situation here, and it's always been competitive. So we've been doubling down on making our products now more affordable, but also broader at the same time. If you look at our delivery segment, over a third of our deliveries GMV came from new products that we created over the past quarters. And that's some of the product-led innovation that we've been doubling down on. But at the same time also, we've got to make those products more affordable to our customers. And we feel that making our products affordable but also reliable has really drove that user-based growth. And also at the same time also driving the retention that we're seeing in our user base. When you look at the number of new MTUs or users on a monthly basis, and we're up over 15% across both of our segments today. So what we've been working on, it's working, and we're going to continue just to make our products affordable, reliable, and accessible.
Peter, let's talk about the newer segment, if I can call it that, with regards to Grab, and the only one that so far is showing a negative EBITDA, and that is financial services. The digital banking system is important for Grab's long-term strategy, and again, this takes a while before you can actually turn it EBITDA positive. What do you think are the challenges and issues that excite or concern you with regards to where this particular segment of the business is going, and how quickly you think Grab can actually get to EBITDA positive? Because as we know, the investors very, very demanding. Just because you're turning positive profit numbers, they will be looking at some of these segments and going, well, when can Grab actually turn positive in this particular segment? What's your outlook with regards to digital banking and when it can actually start to lift itself up in terms of adjusted EBITDA, sir? Yeah.
When it comes to financial services segment, we're committed to make that whole segment break even by second half 2026. We're about 4 or 5 quarters away in getting there. So we're committed and we're very laser focused in making sure that comes to fruition. But what we're seeing at the same time also to get there is we've got to do a couple of things. One is we have to make sure that our loan book in our banks and non-bank business continues to grow. And we saw that in the second quarter, where our loan book now is roughly about $700 million. And that's roughly about 80% growth versus last year. At the same time, also, our dispersal also needs to continue to increase to fuel that loan book. And we're now at a $3 billion annualized run rate of that loan dispersal to our ecosystem. And that's really important, and that's fueling the revenue growth that you're seeing at roughly 41% on a year-over-year basis. At the same time also, how do you keep the credit costs also at a level where with the risk tolerance is bearable? And we're continuing to maintain that also, that risk tolerance, and we continue to keep our non-performing loans well below 3%. So it's a balancing act that we're doing, at the same time containing the cost structure of variable and fixed, but also growing the revenue side on the loan book. And that's how we can actually get to the second half 2026 break-even target. We did say that in our earnings today that we are targeting a loan book of over $1 billion by the end of this year, which is a very important milestone for us to achieve, for us to actually get to that second half 2026 break-even target.